Hello everyone, I'm Dr. Stock, and as of the recording of this video, the CPI has not yet come out, so the things that I have to say about today's CPI, I'm going to only spend a little bit of time on. Really, I want to be forward-looking at two specific months, and I'm going to share that with you from the spreadsheet that I made, and you guys can let me know what you think about it. I also want to talk about retail sales and PPI and just the economic outlook in general, and just a little bit of commentary on the Fed meeting that comes up on March 21st and 22nd. Quickly, do yourself a favor, down in the description, find the link from Moomoo, click on it, sign up, and by making a deposit of $100 or more, you get up to 17 free stocks. This is available through my link. If you make a deposit of $100 or more, you get 7 free stocks. And if it's a deposit of $1,000 or more, you get 17 free stocks. This offer does expire at the end of March, so time is running out. Take advantage of this offer through my link on my channel while it still exists. One other thing, while you're looking down in the description, find the link for the Patreon. If you want access to more of my commentary and see my Patreon exclusives as they come out and be a member of my Discord community, that link for the Patreon is down in the description. We'd absolutely love to have you over there. That said, let's get right into the content. All right, so like I said, I'm not going to spend a lot of time talking about CPI today. What I have for that is 0.4% month over month for all items, and then 0.3% month over month for the core CPI. That's what I believe is going to happen. That is below consensus. I think that we're going to have some really good reads coming out of the CPI today. So we're just going to have to keep our fingers crossed on that. We're going to have to wait and see. And this is something that I did post about back like about middle of February or so, when after the January CPI numbers came out, I immediately went to forecasting, to projecting out what I would see for February CPI, and I got a little bit excited, and as February played out, I remained excited for the February CPI. So we'll see if that excitement was misplaced or if it's in the right place, and since you guys will probably know what that is by the time you watch this video, put that link down in the description. So before we get to more of the CPI talk, looking forward from there, I want to take a quick look at what Trading Economics has for the consensus, for the forecast, not only for today for CPI. Like I said, you'll have already seen it and you can compare it to what it has. Consensus 0.4% month over month. They have it at 0.5% month over month, and I have all items at 0.4 and core CPI at 0.3. So we'll see how that plays out. And let's then scroll down to retail sales. So for retail sales, previously was 3% month over month, and that was a really big one-off shot that we had for consensus for retail sales. So you can see just from this little pop-out chart just how high that was compared to what it was before. And I think what allowed that to happen, look at those two creamy yellow colored bars that we have that led up to January. I think the softness that we had going from October's spike and then soft November, soft December, I think that allowed January to spike up. I think February we're going to see a pullback from that January spending, and autos could be one of those big places where we see that happening. So I think that retail sales, these numbers where we have a little bit of shrinking or pulling back or deflation, if you will, in retail sales, or a reduction in amount of retail sales, is something to really watch out for. I think that we're going to see exciting things from that. I think it's going to be positive for the markets. Now for PPI, month over month, last month came in at 0.7. Core PPI coming in at 0.5. These are once again spikes that we saw in those reports, and we'll see if we have enough deflation in those areas to bring us back from those numbers. I do expect them to soften from where they're at, and if you look at the consensus, 0.3 and for core 0.4, I think those numbers are about right. We'll see when they come out, and you can see Trading Economics even has them around 0.4% for themselves. So I did say that I wanted to take a forward look at CPI. So when you look at CPI, if you look backwards to March and June, those are the 2 months that I wanted to talk about. Look backwards at those 2 months for CPI. We had big spikes in inflation, and while that doesn't do a whole lot for our month over month, which is a more recent telling of the inflation that the data are able to tell us, it does tell us a lot about year over year, and I think that's going to have a big psychological impact when we have the March report coming out in April and June's report coming out in July. And these could possibly be allowing some upward pressure to happen on the markets. Now, there's a lot going on that's more than just inflation reports. I think Q1 earnings and the guidance that we get moving forward from those Q1 earnings, I think those are going to be the bigger players in this, as long as inflation continues to moderate. If inflation does spike back up on us, then that could be something that's a little bit more attention grabbing, but I do anticipate that for March and June, when we get those reports coming out in April and July, that those are things that are going to put upward pressure on the markets. And that's assuming inflation continues to moderate or drop. If inflation does happen to push back upward, then, well, that's a different story because that's downward pressure for the markets. So Q1 earnings, just to be clear, I think are going to be the bigger catalyst as we get into April, as Q1 comes to a close here at the end of March. So let's take a look at the spreadsheet that I made. So this spreadsheet that you're looking at, this is something that I have available over at the Patreon. So if you want to come over, you can check it out. And this is what I shared with my Patreon members with only a few modifications as the data came out and as February came to a close. So what we have for consensus is here in red. I have it coded. You can see I have it marked as consensus. This consensus value that we have is 0.4% month over month, which would bring us out to 5.9% on a year-over-year measure. And I think that's going to be huge because we were at 7, and when we went down to the 6s, that was big news. And then 6.4, and then if we get dropped down into the 5s, that's also going to be big news. But like I said, you have already seen this by the time it came out. I want you to look forward at March, though. By March, holding steady at 0.4% drops us down into the 4s. So even though it is 4.9, if we continue to come in with somewhat lower readings, seeing those 4s come out after we were just at 7, then 6, then 5, like people are going to be counting this down. I think that this would be really positive for markets. And look forward from that. So that is March, and these asterisks that we have up here, what they're marking is that these are estimate values. These are projected values that you see. And I have it from anything from negative 0.1% month over month all the way up to 1% month over month. So this is very broad, and these are factual values. Now, that doesn't mean that that's what they come in at. These are the possibilities that we would get, and there is some rounding that goes along because you actually don't get perfect values on this. So whatever rounds to 0.3%, 0.4%, 0.5% month over month. And the reason why I have it as wide as I do is that most typically we are within 0.2% of consensus either way, either to the high side or the low side. So we'll have to see which way that comes in for us. Take a look when we get out to June. So from May, if we come in at 0.4% for May, June, by sticking at 0.4% month over month, June drops us down into the 3s. Now, mind you, we do need that month over month number to weaken to keep dropping, because if we stay 0.4, look what happens in July. We go back up. So that's something that if the July report comes out, July was a weaker month for us. After such a strong report that we had in June, there was a big drop off in July. So we actually need some of these month over month numbers to soften, to keep watching those headline numbers decrease. So I think April, when we get March's report, is going to be enormous for us. So even if it comes in a little bit hot, we still drop to the low 5s year over year. And I think that that's going to have a positive effect on markets, because the market will put up the headline that inflation is dropping on a 12-month basis. Instead of focusing on the year-over-year number, hocus pocus. They will focus on the year-over-year value. Be like, it's dropping. So just be careful for that, because I think month-over-month is the more important of the two. However, headlines will take a run with that, and that could be enough to positively affect markets. And again, we'll see that happening when June comes out. And if you take a look, if we were able to, and now mind you, this is assuming that we track at 0.4%, and there's a lot that can change. We probably won't hold that steady, especially because CPI tends to fluctuate, that we have peaks and valleys that we don't really settle in between very often. So I do expect this to bounce up and down. January coming in high makes it, in my opinion, more likely that February comes in a little bit low based off of that oscillation that we see. So if we do end up coming in on a lower track, we could possibly even by June see the 2s come back around again on a 12-month basis. So that, watching us go into the 3s by summertime, possibly into the 2s by summertime, that is going to have such a profound impact on the markets, in my opinion, that, that guidance that we have coming out for a possibly weaker economy, that's what I expect to hear coming out from the companies for Q1. We still have, we might have some rough times through Q2 market-wise. It's possible that as we get into Q3 and these reports come out, that we start seeing a little bit of upward pressure because of further moderating inflation. Now, all of this is based on the assumption that we don't have continued high inflation, because that would completely squash, or nearly completely squash, a lot of the case that I'm making. But I do see a path from here forward for our inflation numbers, assuming that we don't get spikes that we don't expect, things that are really out of the ordinary, especially if demand continues to soften and if we hit recessionary times where consumers are really pulling back on their spending. That's something that's going to soften these numbers further. And with softened inflation numbers, that means that we don't need nearly as hawkish of a Fed, which means that possibly we get those pressures coming back off of further rate hiking and also making a better case for pausing or pivoting sooner than expected. Now, one final note on that, because I do have to wrap things up here. With everything going on with the banks, when you look at the CME Fed Watch tool, they've actually priced in a number of rate cuts throughout 2023. I covered that in my last video. So if you watch my CPI video that I have where I cover that in more detail, I don't have the time to do that for this one because I have gone on a little bit already, but take a look at that video and you can see, or even just go to the CME Fed Watch tool yourself and just click through the months. You'll see that we have chances for pause all throughout 2023, and we also have places where they're anticipating rate cuts. So we're going to have to see that happen, and that is good for the markets to watch those rate cuts take place, and that can be something that allows consumer demand to persist a little bit. Some of the damage is already done, in my opinion, and I think that we can still see a slightly weak consumer, and really we want to watch how that affects GDP by watching those demand values come out. And we definitely want to listen to those Q1 earnings for any sort of indication for the guidance that we have through the rest of 2023, what the companies see in terms of the present behavior of their consumers and what they're projecting the consumers to do throughout 2023. And the last mention, student loans. When that moratorium ends, if it does end in June and we start repaying in August, September, whichever one of those two things, because I believe it's 60 days following the closing of the whole moratorium, that student loans enter repayment, that's going to have a significant effect on the consumer as well, which means it can have a significant effect on demand. And with shrinking demand, even if, and especially if we really hit that supply side goes high, that supply outweighs demand, that we could see more softness in GDP, which could affect the entire economy. So I know it's a lot of big thoughts. Thank you guys for listening to my commentary. If you want to hear more of my commentary and see more of my Patreon exclusive content, that is available by using that link down in the description. Click it, check it out. Also, don't forget about supporting yourselves by signing up for Moomoo and depositing your money and getting your free stocks. It also does, both of those things help support this channel, and I appreciate everything that you do, even if it's just watching these videos. Like this video if you have, and if you have not subscribed, please do. My subscriber count quickly growing, and I'm pretty happy about that. And also don't forget about ringing that notification bell to see any time that my videos come out. I'm Dr. Stock, Doctor of Education. We'll see you in the next video.